What if the entire global financial system was teetering on the edge, all because of the price of a single metal? Imagine this. Silver prices don't just fluctuate, they explode. A sudden, inexplicable surge triggers a catastrophic chain reaction. Banks that were once considered unsinkable are now facing collapse. Markets are in a freefall, and public panic is spreading like wildfire. At the heart of this chaos is the Federal Reserve. A small elite team is locked in a high-stakes battle against time. They're not just fighting numbers on a screen, they're fighting a crisis of confidence that threatens to unravel everything. As they dig deeper, they uncover a shadowy network of powerful players who orchestrated this crisis for their own gain. The pressure is immense. Every decision could either save the world economy or push it over the cliff. It's a race to restore order before the system devours itself from within. This isn't just about money, it's about the very foundation of our modern world and the hidden forces that control it. What will they sacrifice to stop the bleeding? If you love stories that pull back the curtain on the world of high finance and conspiracy, you won't want to miss this. Make sure to subscribe for more deep dives into the unseen forces that shape our lives. Thanks for watching. Markets are built on a simple promise. A price is supposed to reflect reality. It should represent what something is worth, what exists, and what can actually be delivered. When that promise holds, trust flows through the system. When it breaks, the damage spreads quietly at first, then all at once. This was the stage the silver market had reached. For years, silver prices were shaped not by physical metal moving between buyers and sellers, but by paper contracts changing hands at high speed. Futures, options, and swaps created the appearance of deep supply and endless liquidity. Most of these contracts were never meant to end in delivery. They were designed to settle in cash, close out early, or roll forward into new positions. As long as few people asked for real silver, the system worked. But something shifted. Large buyers began demanding the metal itself, not the promise of it. When that happened, the difference between paper price and physical reality became impossible to hide. Screens still showed calm numbers, but behind the scenes, inventories were tight and delivery schedules were stretching. This gap was not a technical glitch. It was a structural fault. In physical markets outside the United States, especially in parts of Asia, silver was trading at levels that did not match Western exchanges. These markets did not rely on leverage or rolling contracts. Metal changed hands, moved warehouses, and left vaults. The price reflected what buyers were willing to pay to secure a supply, not what algorithms assumed should exist. The moment those prices diverged, confidence began to fracture. Banks and institutions understood what this meant. If physical prices became the reference point, paper markets would lose authority. Contracts that once seemed safe would be questioned. Delivery clauses would be tested, and some promises would fail under scrutiny. This was not a sudden shortage. Silver had not disappeared overnight. What vanished was the assumption that 1 ounce could support dozens of claims at the same time. That assumption had powered decades of stability. Without it, the math no longer worked. For central planners, this was the real danger. Not rising prices, but collapsing credibility. Once participants believe prices no longer reflect truth, behavior changes fast. Hoarding replaces lending. Delivery replaces settlement. Safety replaces yield. At that point, markets stop functioning as markets. They become exit doors. This was why the Federal Reserve was watching silver so closely. Not because it feared metal, but because it recognized the pattern. Price discovery was moving away from paper. Control was slipping from familiar tools. Part 2 ends here, at the moment when markets stop believing their own numbers, and before the consequences of that disbelief fully reach banks, institutions, and the wider financial system. What made the silver disruption dangerous was not the metal itself, but what lay beneath it. Silver was only the visible point of a much larger structure, one built quietly over years through layers of financial engineering. Most people never saw this structure. Many professionals barely understood its full size. At the center of it were derivatives. When a major bank took a position in silver, it rarely stood alone. That position was tied to interest rate hedges, currency swaps, and credit protections, designed to manage risk on paper. Each hedge created another obligation. Each obligation connected another institution. What looked like a single trade became a network. This network was stable only under one condition. Prices had to remain within expected ranges. Once prices moved sharply, the network tightened. As silver surged, margin requirements rose. Banks were asked to post more collateral to support positions that were suddenly losing money. At first, this was manageable. Liquidity could be shifted, assets could be pledged. But margin calls do not arrive once. They arrive repeatedly and they grow. This is where systems begin to strain. Large institutions do not fail because of total losses. They fail because of timing. Assets may exist on balance sheets, but they cannot always be sold fast enough without destroying their own value. When cash is needed immediately, even healthy firms can be pushed into distress. The risk did not stop at one bank. Each institution had counterparties. Those counterparties relied on the same assumptions of payment and performance. When doubt appeared in one place, it spread. Trust was no longer automatic. collateral demands increased across unrelated markets. This was the same mechanism seen in past crises, but on a broader scale. The volume of derivatives linked to commodities, currencies, and rates had grown far larger than before. The connections were deeper. The dependencies were tighter. Clearinghouses, designed to reduce risk, now became amplifiers. Their rules forced action at the worst possible time. They demanded collateral precisely when it was hardest to provide. What protected the system in calm periods accelerated stress in volatile ones. For regulators, this was the nightmare scenario. Not a single collapse, but a chain reaction. One failure led to caution. Caution led to hoarding. Hoarding drained liquidity, and liquidity, once gone, did not return quickly. Silver had exposed this web. It revealed how many promises depended on stability and how few were designed for rupture. Part 3 ends here, before defaults appear in public view, and before institutions are forced to choose between survival and the wider system they support. By the time policymakers fully understood the scale of the risk, their freedom to act was already shrinking. The problem was no longer technical. It was political, legal, and structural at the same time. Every available response carried consequences that could not be reversed once chosen. This was the narrow corridor facing the Federal Reserve. One option was direct intervention. Liquidity could be provided to stabilize markets and allow institutions to meet their obligations. On paper, this solution was simple. In reality, it was fragile. Public tolerance for rescues had collapsed after years of inflation and rising costs. Any action that appeared to protect large financial institutions would immediately face resistance and scrutiny. Another option was to pause the market itself. Trading could be halted, settlements delayed, and time bought. But markets exist on confidence. A forced pause signals weakness. It tells participants that prices can no longer be trusted. Once that message is sent, capital looks for exits elsewhere. Doing nothing was also a decision. Allowing markets to adjust naturally meant accepting failures. Some institutions would not survive. The risk was not their collapse alone, but the reaction it would trigger. Credit would tighten, lending would slow. Businesses far removed from silver would feel pressure they could not explain. There were no clean solutions because the system had been optimized for efficiency, not resilience. For years, stability was assumed. Risk was priced as low probability. Leverage made returns look reliable. That same leverage now limited escape routes. For businesses and investors watching from the outside, the lesson was clear. Systemic events do not announce themselves loudly at first. They appear as technical issues, isolated moves, or niche market disruptions. By the time they reach the front page, the outcomes are already locked in. This moment was not about predicting collapse. It was about understanding constraint. Policymakers could influence how pain was distributed, but not whether it existed. Markets had already begun adjusting. Trust, once questioned, does not return on command. Part 4 ends here at the point where choices narrow and consequences accelerate. The decisions made within this corridor would shape credit conditions, capital flows, and confidence long after the immediate crisis faded. The warning was not emotional. It was structural.